Hi, and good afternoon. As many of you know, my name is Maggie Sweeney, and I am the Executive Director of Washington Defense Trial Lawyers. We will get started with today's Lunch and Learn in just a few moments. We want to allow a little bit more time for attendees to join us. Okay, let's get going. Once again, my name is Maggie Sweeney. I'm the Executive Director of Washington Defense Trial Lawyers. Thank you for joining us today. Today's topic is what happens when 50-50 owners disagree on the value of their business. And this Lunch and Learn is being brought to you by Eli Neal and our one of our new core sponsors, Four Corner Financial Forensic. I'm going to let Eli go ahead and introduce himself more fully, but I do want to thank Eli for supporting WDTL and being one of our core sponsors. Eli, you help us make or help us put on the great programs that we are known for, so thank you for that. As far as today's program goes, we are approved for 1 CLE credit. I will be submitting for you, so if you you don't need to worry about that. Just give me about 30 days to get it into your account. And if you are calling in or dialing in on your phone, please email me at maggie@wdtl.org and let me know that you were joining us by phone, and I will make sure that you are added to our list. If you have any questions for Eli during his presentation, we ask that you use the Q&A function that's on the bottom ribbon of your screen. This is much easier for Eli as the sole presenter to be able to track those questions and answer them because we are in webinar mode due to the number of attendees for today's presentation. And lastly, I want to remind everybody that WDTL is undergoing our membership drive for the 2021-2022 membership year. So if you have not renewed, we'd love for you to go on to WDTL.org and renew. And if you are interested in becoming a member, please go to our website and consider joining this fantastic organization that does great work. Or WDTL is only as strong as our members. So thank you so much. At this time, I'm going to turn it over to Eli Neal. Eli, once again, thanks for being here, and I am looking forward to hearing what happens when 50-50 owners disagree on the value of their business.
Great. Thanks so much, Maggie. It's my pleasure to be associated with WDTL. I have heard amazing things from many attorneys about the organization, so it's my pleasure to be here. I am Eli Neal, and I'll be talking about shareholder dispute, specifically with 50-50 owners and when a buyout purchase is necessary. And our agenda today is going to be a little bit about my background, then some accounting 101 and business valuation 101, just so that we start with kind of a shared understanding of financials, accounting, and business valuation. I know we're all starting from a different point. And then we'll get into the case study, which is based on true events. And if anything comes up throughout, please do feel encouraged to ask any questions through the Q&A function. That will help liven it up, keep it interesting, and make sure I don't miss anything. So I appreciate your help there. I know it's a little challenging when we're online, but please feel encouraged to participate. So who am I? I am Eli Neal. I had to change my slide. I am a formerly proud Husky alum. The first 2 weeks of Husky football did not go so well. But I did graduate from the University of Washington. And then I started my career at Ernst & Young, which is one of the big 4 public accounting firms, handles audits of large private companies and public companies as well. I started my career in Seattle, Washington, and then transferred to the Portland, Oregon office of Ernst & Young because my beautiful wife, Jamie, pursued her master's degree at Portland State. So I worked for Ernst & Young for 4 years between the two office locations, and then got recruited by a former coworker to join a firm called Cogents Group in Portland, Oregon. And it was the perfect time for me to leave public accounting and enter the interesting, fascinating, challenging world of financial forensics with Cogents Group. And there we did business valuations, forensic accounting, and economic damages. I was there for 5 years. And then with our 2 young kids, we decided to move back up to Washington in December. So we've been up here since December, and I started my firm, Four Corners Financial Forensics then. I am a CPA, an ABV, accredited in business valuation, and certified in financial forensics. In 2018, I was awarded a standing ovation award from the American Institute of Certified Public Accountants, and that recognizes individuals under 40 years old for remarkable professional achievement. So I was very humbled to receive that. I mentioned my wife earlier, and we have 2 young daughters, Blair and Avery. I think perhaps the most useful thing of this presentation, no, I joke, but we went to Maris Farms in Buckley, Washington with our 2 daughters. And if you have any young people in your life, I highly recommend going down there. They're in the process of converting from a sunflower farm to a pumpkin farm and corn maze, and it's $18 an hour from the city, and all kinds of free activities for your little ones. So whether it's your children or grandchildren, I would highly recommend you go there. So what does my firm do? Well, I think of it as we inform good decisions. How do we do that? We partner with attorneys and clients to make sure that they understand their case. And then we explain the case to judges, juries, and arbitrators. My personal testifying persona, because I think that is really important. I'm earnest, I'm detail-oriented, and I'm objective. I think of myself as a happy warrior to explain the case to the judge, jury, or arbitrator. It is a dispute, so there are certain assumptions that have to be made, and my job is to make it clear what those assumptions are and why my assumption is well-founded and well-reasoned. And again, what do we provide? Business valuations, forensic accounting, and economic damages. So we'll start with Accounting 101. And we'll start with what an income statement is, just to make sure we're all on the same page. So an income statement measures over a period of time, what are your revenues or sales minus your expenses, and that equals profit or loss. Okay, so think about the year 2020, sales minus expenses equals profit or loss. And a common term of art is EBITDA. And so I wanted to walk you through what EBITDA was. And that's earnings before interest, taxes, depreciation, and amortization. And why is that important? Well, it's important because it ignores and removes the influence of management decisions. It's management's decision whether to take on debt and pay interest. It's management's decision how they structure their business for tax purposes, how quickly they take depreciation and amortization. And so valuation professionals like myself really care about EBITDA because it strips away all of those decisions and boils a company down to its operations, its operational profitability. And so that's the term, and that's why it's talked about so commonly. The next key financial statement is the balance sheet. And this is at one specific point in time. So it's very different than an income statement. It's as of a single date. And the balance sheet is assets equal liabilities plus shareholders' equity. That's always the formula. And assets are things that you own. So cash, accounts receivable, fixed assets. These are things that you have that have value. That's an asset. Liabilities are expenses that you owe people. And so it could be debt on your books that you owe a bank, such as a mortgage. It could be payable to one of your vendor in the form of an invoice. And shareholders' equity is the difference between those two. How much do you have in assets compared to how much do you owe in liabilities? The difference is the value that sits within the company. And it is really important to note that balance sheets can be misleading. So make sure you kind of understand that you need to understand the context of a balance sheet. And I have an example here. So let's say it's December 30th, 2020. Your company has $10 million of assets, $1 million of liabilities. Well, then your shareholders' equity would be $9 million. Now, say the next day, so it looks like your company is very strong. Now, the next day, you have assets of $2 million, liabilities of $1 million, and equity of $1 million. All that happened is that you decided to distribute $8 million of cash, let's say, okay? And so all of a sudden, just from the decision to distribute cash from your business, you go from looking like a $9 million company to a $1 million company. And that's why we want to be very careful looking at the company's balance sheet and thinking that that is an indication of a business's value. Because if you just looked at the 12/31/2020 balance sheet, you would have a misrepresentation of the value of that business or really its operations. It's hard to see a company's operations from a single balance sheet. So that is an important point. And then, you know, the other thing to think about and be wary of, kind of stash away in your brain, is that there's cash basis accounting and accrual basis accounting. Now, cash basis recognizes revenues and expenses at the time that cash is received or paid out, okay? Not until it hits your bank account. Accrual basis accounting, on the other hand, recognizes revenue when it's earned and recognizes expenses when liabilities are incurred. And then it, you know, regardless of when the cash is received and paid out. And so that's really important. It's really important to understand what type of financial statement you're looking at. Is it cash or is it accrual? And again, I have an example here to illustrate the point of you know, how that can have a big impact. Well, let's think about revenue. If you did a lot of work in December 2020 and you invoiced at the end of that month $1 million, but you haven't received the $1 million, and then that $1 million is received ultimately in January, on January 15th, 2021, well, is that $1 million of revenue going to be recognized in 2020 or 2021? You know, accrual would have it in 2020 because that's when you perform the work. Cash would have it in 2021 because that is when you ultimately were paid for that invoice. And so this is another tricky area where you kind of need to be aware of what financial statement you're looking at to understand the operations of the business. And so be careful, because the type of financial statement you're looking at can be misleading. Now, if you have any questions on that kind of quick breakneck trip through Accounting 101, please feel free to ask any questions through the Q&A function, but if not, we will move on to Business Valuation 101. And so we'll start with valuing privately held businesses. And we do that as of a single specific valuation date. And the valuation date is very important because valuation professionals can only consider data and information available as of the valuation date and before, okay? And so anything that happens after our valuation date, we have to ignore, can't be in our report, can't consider it in our assumptions. And so one of the very first things I ask in any valuation engagement is, what is my valuation date? Because that freezes us at a point in time. And regarding the type of business, we can value either operating companies or property holding companies. The type of business changes the valuation approach that we'll likely use, but there are kind of certain fundamental facts that ring true for an operating company, and then certain fundamental common approaches for property holding companies. And operating company is one that maybe sells inventory and generates profit, whereas a property holding company may own a piece of real estate and rent it out to a business. And that's kind of the whole function of the company. It just holds real estate. And there are three approaches that are used to value a business: the adjusted net asset approach, the market approach, and the income approach. And the adjusted net asset approach is typically used for the property holding companies. And what we're doing is we're looking at the balance sheet, which we talked about. Assets equals liabilities plus shareholders' equity. We're adjusting every line on the balance statement, on the balance sheet, to fair market value. So if it is a property holding company, we'll get most likely a real estate appraisal for that property. And we can also go based on the most recent tax statements for the tax assessed value. We'll talk to the client, or you guys, the attorneys, as to which we would like to use. But we'll take the assets, mark them to their true value to a business owner. We'll look through the liabilities, make sure that they are all true liabilities of the business. And now that we have our assets at market value, our liabilities at market value, the difference that falls out is a true representation of the current value of the business. Now, that's commonly used for a real estate holding company, as opposed to an operating business, because an operating business that maybe is selling inventory for profit, they're generating value by making sales, from buying inventory, making sales, and generating a profit from those operations. And so typically, there's not many assets on the books there. And so we'll use one of the other approaches for an operating company. The market approach relies on sales of similar businesses to value the subject company that you're looking at. And so we have at our fingertips databases of historical transactions, typically going back to the 80s, but there are thousands and thousands of different types of businesses with the transaction data. And so we'll look for a similar type of company, look at what its revenues are, look at what its profits are at that period of time, and draw comparisons to the company we're trying to value. This relies on actual transactions that have happened, and you're looking for a comparable company in terms of its operations, its size, its revenues, its income, and then also you're hoping to find transactions that are recent maybe within the last 5 or 10 or sometimes 15 years to value your business, and you're making comparisons between the two. And then the final approach that we use is the income approach. And this looks at a future cash flow stream. So you project the future cash flow stream out over a period of time. And then you use a discount rate to present value to today's dollars. And the discount rate is really a proxy for risk. How reliable are the cash flows that you're projecting into the future? If your cash flows are very consistent, then you'll have a lower discount rate, and as a result, a higher value. If your cash flows are very risky or very volatile, you'll have a higher discount rate that will, in effect, discount the future cash flow streams a greater extent, and you'll have a lower value. And so kind of the general equation there to think about with the income approach is that higher risk, less value, lower risk, higher value. And that kind of does make sense. Just thinking about it generally. And so the next thing I wanted to go over, because not everyone knows, is the valuation process. And I would say in general, it's a 4 to 6 week process to receive a valuation. And I kick it off with an initial document request list. There's about 15 documents that I ask for. It includes the financials, so income statements, balance sheets, tax returns, and then also key agreements. So operating agreement, buy-sell agreement, maybe there's other shareholder agreements, kind of anything that dictates how the business is to operate. We'll ask for those governing documents. And then we're asking for customer lists, vendor lists, among a few other things to get a really comprehensive, complete financial picture of the business. After we receive those initial documents, we'll review them, we'll plug them into our model, and we're looking to identify historical trends, anomalies, things that are, not in our expectations, things that we just have questions about. And then we're also determining likely valuation methods. I'll usually look into the transaction database to see, how many companies are the same type of company over the last 15 years. Do I think I'm going to use the market approach, the income approach, the asset approach? And so kind of doing the preliminary initial work. And then we have a management interview with the founder, CFO, CEO, whoever makes sense to really speak to the business in total. And that is typically about an hour and a half call. And we talk through the financial questions that we've generated and also all the qualitative aspects. Who are your key customers? Who are your key vendors? Could you continue to operate if you lost one of your vendors? Are there any governmental or environmental regulations that you're dealing with? Really kind of the full picture, because just as important as the numbers are the qualitative aspects, right? That's informing the riskiness of the company. And I just love the management interview part. A lot of CEOs and founders, I think, also really enjoy it because we're taking an hour and a half to dig through their business and really reflect. And I think they come away, they leave that meeting, learning about their own company and the risks that are apparent. One other risk that I forgot to mention is key person risk is one that I see often, especially in smaller businesses. How important is the founder to the business? And if the founder were to leave suddenly, would the business be able to keep on thriving as it is now, or would it take a huge step back, or would it cease altogether? That's a big risk in a business, one that I see common. So that's what the management interview is for, is identifying those types of risks. And then after the management interview, we get so much good information from that interview that we go back to our model, fine tune things, make adjustments if necessary. And then, maybe there's a bit of follow up or back and forth, but then we'll finish our work product. And the work product is another place that I want to really emphasize and make sure that you guys as leading attorneys understand the options that you have available. I think too commonly attorneys think about the work product as a full appraisal report, which is costly, it is time consuming, and is 30 to 50 pages, but there are more options available than just the full valuation report. And I think, especially in dispute work, litigation, the other scopes of work can really make a lot of sense early on. And so the first scope of work is what I call valuation consulting. It is Excel schedules, and at the end, right, the modeling that I was talking about, we put the same financials into the same Excel model, and we do our valuation work the same as we would do for a valuation report, but we're cutting out all of the expense of writing a 30 to 50 page report, spell checking it, documenting our assumptions. And so it's a lot more cost effective to just get the information into Excel and have us take a look at the value. And for this, we then, I finalize my schedules, provide them across to you, the attorney, sometimes the client as well, or you, the attorney, can pass them on to the client to maintain protections, to maintain privilege. And then we'll hop on a Zoom call, and I will walk the client and you through, all of the numbers and the valuation conclusions. And the goal with valuation consulting is to give you and the owner a very clear picture of the value of the business without incurring a lot of expense. We can do the valuation work first, get a really good idea of value, efficiently. About 20 hours is typically all that it takes. And then you can use that value estimate as needed. And then if at a later point we need to do a valuation report, we can use that same work and then just start writing the valuation report. Nothing's lost, not much time. There's not much extra time that's incurred to break up the work like that. Really just the debrief call, which would be about an hour, is the only thing that's wasted. And then, and it's certainly not wasted, but that's the only thing that's extra. But if it makes sense at a later date to write the valuation report, then that's what we'll do. But we can kind of stage it so that it doesn't have to be so all or nothing. I find often that attorneys, will call me asking for a valuation report when maybe consulting makes sense first to inform mediation or just negotiations between owners in this case. So that's the first option, and I really do think highly of that option, valuation consulting. So write that down in your notes as an important takeaway. The next option is a calculation letter, and this is kind of the next level. It's a 8 to 12 page letter, high level, documenting what we know about the company, some of the assumptions that we've made about the company's value, and then memorializes our calculated value. And the calculation letter is in our business valuation standards as a scope of project. It's really great for businesses that have multiple owners or multiple stakeholders because it eliminates the possibility that something could be lost in translation. If there's multiple owners and I give only Excel schedules and a call, then perhaps there's a chance that each owner hears something differently or zoned out during one part of the call and didn't hear the conclusion. And so calculation ladder is, I think, better as a middle step for larger companies and those with multiple stakeholders, because it removes the possibility for miscommunication. And so it's a good half. And then the final kind of scope of work product is the full valuation report. I think that this is what a lot of people think of when they think of valuations. It's 30 to 50 pages. It talks about the company in detail, customers, vendors, government, management, individuals, history, and then all of the assumptions used in the asset, market, or income approach are all listed out, and it concludes with a valuation conclusion. It is for IRS reporting, for gift and estate tax purposes, and it is for trial so that I am able to testify that this is my opinion of value. It is to the highest standard that valuation professionals have, and you can read my report, and I'm happy to testify to it. Of course, it is the most costly because of the level of documentation inherent, but that's what we need sometimes, and we love to do that work as well. Okay, so the moment has come for us to switch our brains to the case study now that we have the background of accounting and business valuation. Again, if any questions come up, please feel encouraged to ask them, and I'd be very happy to clarify anything as needed or answer any questions. But without further ado, we will move to the case study. So to protect the innocent and not give away too much, we will refer to the company as Work From Home Company, aka WFH. And generally, it's important to know that this company helps workers do things remotely. And so to the extent that people are working remotely, that would significantly increase their business, as you will soon see. They are a professional services business, and that's similar to a law firm or an accounting firm. Their investments are in the services they provide to their customers, and so there's not much in the way of assets with this business. It's really providing a service to their clients and paying their employees and then profiting. Similar to a law firm or an accounting firm. This company had an operating agreement, which was printed from a website. And, I think we've all seen that too often. It causes a lot of problems on the back end to have an operating agreement that's not well done by an attorney. So I always recommend that my client, that really anyone I talk to, get an attorney to help them set up their business, as opposed to finding an agreement online. But we all know that so often people find their agreements online. And so that is the world we live in. The buy-sell agreement, or the buy-sell section of the partner of the let me take a step back. It was an LLC, and the agreement that they had was a partnership agreement. So that right there illustrates the trouble with website agreements. But this operating/partnership agreement did have a buy-sell section, and that section stated that each party would retain an appraiser, And if those appraisers were not within 10%, then a third appraiser would be appointed and that price would be binding. Okay, so that's the frame of reference for these owners. In the middle of 2019, buyout discussions began between these two 50-50 owners. But as happens, things would be, kind of delayed and talked about, but not acted upon. One important factor here is that the two owners agreed that a change needed to happen because they were not getting along. And they also agreed on which owner would be staying and which owner would be going. And that is crucial because when it's clear which owner is staying and which owner is going, it drives the incentives. The incentives are very clear in that the selling owner wants the value to be as high as possible, and the purchasing owner wants the value to be as low as possible. And so in situations where there are defined roles of which owner is staying, which owner is going, that's something to consider from the outset, is that there are very strong incentives in place. So looking at the timeline, buyout discussions begin in the middle of 2019. The attorneys are not in a hurry to wrap up negotiations, and frankly, neither are the owners. Everyone's kind of just operating status quo with the idea that someday, they'll buy each other out. The first selling offer happened in February 2020, and that was $400,000 for 50%. Okay. And that was unanswered before the COVID-19 shutdown. Just shortly thereafter, the initial offer, I think of the COVID shutdown really starting March 12th, 2020. That was the day that the NBA season was suspended. And it just felt like when the NBA pulled the plug on that game, everything else came kind of crashing down as well. I was in San Diego just the weekend before that March 12th date. And then the next weekend, that would have been out of the question. So that's what I pegged the COVID shutdown start to. So anyway, initial offer right before NBA season shutdown. The follow-up offer was then made in October 2020 for $1 million. And that is foreshadowing the change in the company's fortunes. And the owner that would be staying and buying, was absolutely incensed by the $600,000 price increase of the 50%. I mean, enraged by it because he couldn't understand how in 8 short months, the price would increase, more than double to buy $600,000. So rejected it outright. And then we were formally engaged in December 2020 with a valuation date of December 31st, 2020. So let's look at the financials of the business during this time. You'll note that these are cash basis financials. That will become clear later why that's important. From 2016 through 2019, there's a clear downward trajectory of the business. Owners were not getting along. The business was, less profitable over time. You can see that the gray bars are net revenue and the blue bars are EBITDA. And so we kind of have a struggling business that's going the wrong way. Well, what happens in 2020 to our work from home company? Gangbusters, the best year that they have ever had. Their revenues jump from 1.1 million up to 2 million. Their EBITDA jumps from about $80,000 to up over $520,000. And so you're thinking that they're doing great. Even the buying business owner thought that he was doing great. And they've always historically looked at their business on a cash basis, right? So these are the financials that he's looking at. But as a valuation professional and as attorneys, what you should be caring about is accrual basis, not cash basis, because accrual basis shows the activity that they performed in 2020 and how that is going to translate to profits. And crucially, this was a business that was performing work all through a month and then invoicing at the end of the month. So they ran into the December 31st revenue problem. So when we got in there and asked for accrual basis numbers, we saw even better performance. They had actually billed for $500,000 worth of work in December 2020, but they had already paid all of their employees, all of their vendors. And so what we saw is that, and I'm going back and forth here, cash basis, they were $2 million, $510,000 of EBITDA. Accrual basis, they were up to 2.5 million and $1 million of EBITDA. And so, that right there was a surprise to the business owner, because he had always just thought about his business on a cash basis. But it's really important to think about it in an accrual basis, because next year you'll be able to do the same type of work, generate the same type of profits, perhaps, or the same opportunity to. And so all of a sudden you've got a business that's making $1 million, that made $1 million in 2020. And we think about what the business owner, did with that follow-up offer. He had a knee-jerk rejection of offer number 2 for $1 million. And based on what? He was upset and emotional, but why not hire a consultant at that point to do 20 hours worth of valuation consulting to inform his decision before kicking off a formal appraisal process? I just think that is really well done. Would have been a fantastic thing to do in this case. And how could a consulting appraiser have helped in that situation? Well, the first thing that is apparent to me in these types of situations is that it's very murky what the future holds. In the next 3 years, you look at the trend of downward and then a significant bump. Do you think that performance is going to continue to increase or flatline as a result of COVID? Or was this a temporary improvement and the business is going to, kind of go back to pre-COVID levels in 21, 22, or 23? It's hard to know. And so that makes it a challenging valuation in and of itself, the financial characteristics of the business. And so I kind of talked about this first bullet point there, it's unclear what will happen in the future. And that means that there can be a wide range of values possible based on those future assumptions. I say here, can I borrow your crystal ball? Because it's going to be really hard for me and another appraiser and the 2 business owners to get on the same page about what the future is going to hold for this business, because we don't have a clear track record of the business's historical operations. Again, a consulting appraiser would have been able to point out that EBITDA was $550,000 on cash basis, was actually $1 million for accrual basis. As a result, an offer of $1 million for 50% values the company at only 2 times EBITDA. That's on the lower end of the spectrum in terms of valuation multiples. So all of a sudden, that increased offer number 2 makes more sense in this context. And the other thing that I, would have done if I were the consulting expert or consulting appraiser is we could have modeled out each of those different scenarios. What's the value of the business if it keeps increasing into the future? What's the value of the business if the business kind of maintains its COVID levels? And then what happens if it decreases? We can just model and talk about the different value indications. But as we know, there was a knee-jerk rejection, and instead, appraisers were engaged by each side. We were engaged by the buyer. A reputable appraiser was hired by the seller on the other side. Both appraisers talked to each owner. So I had the opportunity to have a management interview with my client, and with the other 50-50 owner, the other appraiser had the same opportunity. As often happens, each party's future expectations matched their incentives exactly. And so, this is very, very common, but the buyer, my client, expected performance to drop to between COVID and historical levels. He thought it was a one-time occurrence. And the seller, who was going to be bought out, expected performance to continue to increase, and they would, ride the rocket ship up and up and up, and they would become the next Amazon perhaps. And that is very common for parties to tell us what lines up with their incentive. Each owner provided projections for the next 2 years. They each did that independently, and of course it matched up with what would benefit them financially. And so myself, the other appraiser, performed our valuation analysis. What approaches did we use? Well, we both rejected the adjusted net asset approach because, again, there were not many assets within this business. It's a professional services business. And so that's not the best indication of value here. The next option is the market approach, and we differed here on whether we used it. I rejected the market approach because I felt like COVID is such a unique one-off event. And so if you're looking at historical sale transactions in a database, those would all be from before COVID. And so the market may be valuing this type of work from home business differently pre-COVID than after COVID. And also, and so that's one variable is, are the multiples that we use from the database going to be helpful in this example? I felt that I could not reasonably defend their reliability. The second factor in the market approach is the financial performance. And within that financial performance, again, we have that question of, is the future going to look like the past? And if so, what version of the past? So I rejected the market approach outright. The opposing appraiser actually used those historical pre-COVID multiples and weighted it as 50% of the value conclusion. And I think if we had made it to trial, our side's attorney could have made a reasonable case to exclude the market approach because of its unreliability, in my opinion. But both appraisers landed on the income approach, and we accepted a 2-year discounted cash flow method based on those 2-year projections that we used. So our valuation compared each owner's projection on a line-by-line basis, and we documented our rationale for the assumption that we made when the two owners differed. Some line items, they were in lockstep and they agreed. some line items, they were drastically different. And so in those cases, we documented our assumption clearly in our report, and we selected a future cash flow stream in between 2020 performance and historical performance, acknowledging that it seemed likely that there would be a 1 year kind of 1 year increase based on the type of work that they did. And we ended up at $950,000 for 50%, which I will remind you is very close to the offer number 2. The other valuation report ended up using the selling owner's projections exactly. There was no difference in any of the numbers between selling owner's projections and the appraiser's projections. And honestly, I think that was an unprofessional choice when that appraiser had access to both owners and had access to both projections, but he used them exactly. And as a result, their valuation landed at $2 million for 50%. So now we have a large dispute between should it be $950,000 or $2 million for the 50%, when again, the selling offer, the number 2, was for $1 million. So we were not within 10%, and a third appraiser was hired. This third appraiser had access to all the documents provided to us, the initial appraisers, access to both valuation reports. The third appraiser had a joint interview with both owners at the same time to kind of have them go back and forth and explain why one thought the business would continue to increase and why the other thought it would decrease slightly. And then I loved this part. So kind of another thing to star in your notes is that the third appraiser had individual conversations with each of the initial appraisers. So, I was able to, for an hour, walk through the other appraisers' report, point out that the projections were only the selling parties and, clearly biased, and point through other fundamental flaws using the market approach in general. I was able to point that out. So it was really a valuable use of an hour to have us be able to talk to the third appraiser and not lose the knowledge that we gained during our process. I would highly recommend that when encountering third appraisers. And then also they were allowed to perform follow-up requests. And so the third appraiser, let's acknowledge the fact that oftentimes third appraiser's value will come up in the middle of the value range. So if we got 2 appraisers that have done work, $950,000, $2.05 million, that third appraiser is almost always going to come up in the middle of that range. And honestly, that is another risk in involving a third appraiser, and why I believe that the selling party's appraiser was trying to get their value as high as possible by using the really aggressive projections. It's to get that range as wide as possible so that the third appraiser feels like they should be operating and kind of splitting the baby in the middle of that range. So that's something to be careful of. In the end, the third appraiser did use a 2-year discounted cash flow method, similar to both of us before, and ended up at $1.1 million for 50%. And so in the end, the owner paid $1.1 million when he could have paid $1 million. And also the professional fees incurred for my firm, for the opposing appraiser, the third appraiser, and the lawyers along the way to manage the process, were probably easily over $150,000, which is significant. And so lessons learned. What did we learn along the way? Well, I think I think that these are all really insightful comments that you should write down. But owners do overestimate their ability to value their own business. Sometimes up, sometimes down. But again and again, I see that owners often do not have a great understanding of how a third party would value their business. And they make decisions before getting a professional involved, and that can lead to negative outcomes, as we saw in this case. The facts impact the likelihood that appraisers' values will be close. Just by looking at the volatile history of this company's earnings and revenues, I could have foreseen that we would be looking at two appraised values that were disparate. The more consistent and stable the company is, the more likely that the valuation conclusions will be close in value. The more volatile in nature, well, it's just more unclear what is going to happen in the future, and as a result, that drives the values to be different, typically based on each party's incentives. Value consulting is underutilized compared to the cost benefit. The cost is not much, and in this case, the benefit could have been huge. We could have gone through the Excel schedules, charted out that on the high end, maybe we're at $2 million, the low end, $950,000. Maybe take the deal or just negotiate it slightly down to $950,000, or meet in the middle at 975. Everyone goes their separate ways. There's a lot of, both financial costs avoided and also emotional distress for these two owners that had worked together for 8 years, and by the end of this process, couldn't stand each other even more, unfortunately. A lesson learned that I didn't hit on too much during the case study is that it is important for the appraisers to limit the ability of parties to provide unrequested documents. One of the challenges with this case is that the selling owner kept providing updated projections on a twice a week basis, which added to some confusion as to version controls, and also added expense to keep looking at updated versions. So I would try to limit that in the process. And then an important factor, I think, in getting the value as low as it was, especially compared to the opposing appraiser, was to have the initial appraisers discuss their valuations with the third appraiser, and be able to kind of make their arguments and make their pitch for their own valuation. And finally, do you guys have any questions for me? They can be questions about today's case study, general questions. I am teed up for another presentation on November 9th. And one thing that I'm curious about is whether you would prefer a presentation on economic damages or on business valuation discounts. So if you have a preference one way or another, you can let me know. I'm kind of on the fence about what to present right now. And finally, do you have a dispute that you would like to discuss formally or informally? I would love to help. I love to help attorneys, and I love to help their clients. And really, I view my job as presenting a clear picture of the situation and raising up the assumptions that we need to make, and arguing for the assumption that I think is best. That is my job, and I hope that I can bring clarity to you all and your clients. My contact information is there on the slides. I will wait just maybe 20 seconds or so to see if any questions come in. Well, I am not seeing any. So if you have questions, feel free to call or email me. Also, if you'd like a copy of this slide deck. Oh, we got one. Perfect. Could the case have resolved with a mediation? Do you think the parties' respective forensic accountants would have had to be present? I think that is possible. Probably the earlier in the process that could have been proposed and have been the plan, the better, because by the time we went down the path, each side was, kind of got really stuck in their projections, and it got pretty contentious. So I think that what would have been great is from the outset, if the attorneys had proposed mediation, each with their own valuation professional, that could have changed the tone. And then I do absolutely think, and have before, presented at mediation to defend my work and explain it, and then also to walk through the other professionals' opinion and explain, why I differ on certain assumptions. And so, yes, I think mediation is great, although I've seen that it helps the earlier in the process, just set the tone. So thanks for the question. Appreciate that. And I think I was going to say, if you would like the slides, feel free to email me and I'll shoot them over to you. And yeah, happy to be back in Seattle, and I look forward to working with some of you. Thanks so much. Have a great rest of your day.